I get way too jacked up. It's Millennial Money Night. Oh my goodness, guys. Woo! I get way too crazy on Tuesdays. All right, we gotta talk about this, okay? Friends sent me lists last night. Stocks could drop another 20% when Fed fights inflation, okay? I said I'm always willing to listen to whatever somebody has to say out there. I might make no decision based upon what that person tells me, but I'm always willing to give somebody respect and at least listen to what they have to say in regards to a stock or in regards to the market. So this hedge fund manager is saying we could drop 20% rather quickly, okay? So what we're going to do in this video, we're going to go ahead, we're going to look at exactly what they said, okay? We're going to go through it. Then I'm going to give my opinion on if I think this is a bunch of baloney and they're misguided, or if I think, oh man, they might be onto something, because they do have some interesting takes here that is a little differently than I've heard from other folks out there, okay? Now, real quick, we got to talk about this, okay? Very, 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 very important, okay? Essentially, doesn't matter what type of market you're in. It could be a bull market, a bear market, a market doing nothing. And you will always have some folks out there that say the market's going to fall 20, 30, 40, 50%, whatever, okay? It doesn't mean I don't want to at least listen to what they have to say, but just keep in context, it does not matter what is going on. The best economy, the worst economy, low interest rates, high interest rates, no, it doesn't matter. There's always going to be some folks out there, some hedge fund managers and different folks that are saying, this is the end of the stock market. This is the end of, crypto. This is the end of the dollar, whatever, okay? And so that is something that's just very, very important to keep in mind, especially for anybody newer watching this video that, let's say you're in your first year of investing or caring about stocks and the market and things like that. Just understand, this is normal. You will always get folks talking about this. And it's important to kind of listen to what they have to say, but to make judgments based upon that is a little misguided, okay? Now, let's be very clear here. The market has started to weaken recently, and it's led some folks to think, ooh, maybe there's something going on here. We're hearing about all this inflation craziness, right? And we're seeing the NASDAQ start to weaken. We're obviously getting to the point where stimulus money's dried up. So that whole stimulus push, right? Stimulus is getting pulled back now, right? All those stimulus checks are already out there. And so folks are like, oh man, that was kind of something that was positive for the market, that the market was looking forward to. Oh, a bunch more stimulus money is going to get pumped out there. To now all that is starting to dry up. And the market has been dropping recently, right? This is a 1 month in the NASDAQ. I mean, it's clear, kind of what's happened to the NASDAQ, right? And you look at a day like today, everything was down. The Dow was down 267 points, S&P 500 was down 0.85%, the NASDAQ was down 0.56%, and the Russell was down 0.73%, okay? You know what wasn't down? This one stock, okay? The Chef! The chef is back from the dead. The chef is back from the dead, okay? Maybe this is why I'm so jacked up today, man. Ever since 420. Who would have known 420 would have been, well, it depends on which way you're looking at it. The worst day ever? The best day ever? I don't know. Maybe that was just the best day ever because I was buying call options left and right when that stock was $15. But needless to say, this stock is starting to turn into one of those where it almost seems like it doesn't matter what happens in the market. This stock is going to do whatever this stock wants to do. And I think that's really, really important. That's something I sometimes look at, when it comes to stocks, is like I watch Tesla kind of go into that mode. If you watch in late 2018, the whole market was tanking, man. Everything was getting ugly. And yet Tesla stock was moving up during that time. And it was like, Tesla, just doing whatever it wants. Same thing in 2019 and in 2020. It just, obviously went absolutely crazy, right? And so the chef, here today, everything's down in the market, and the chef just makes a massive upward move. And it's just, as the market, you can pull up a month chart of everything as far as the indexes go. They're all going down and down and down. And look at the chef. It just continues to move up and up and up. Interesting there, okay? So let's get into what this hedge fund founder had to say and kind of my thoughts on this, okay? Don't forget to smash that thumbs up. That's all I ask in return for this video. That helps us out huge in the YouTube algorithm. I appreciate all you guys for being here. Much love as always and putting up with me when I'm all jacked up, okay? Inflation fears already roiled the market this week with the NASDAQ falling nearly 2%. But one hedge fund founder is sounding the alarm over a potential 20% collapse. Not a small amount, okay? 20% collapse that could be sparked by the Federal Reserve signaling an end to accommodative pandy era monetary policy later this year, okay? So right off the bat, talking about the Fed signaling an end to accommodate, so basically saying that the Fed, with all the sloshing of money the Fed's pushed out there, right? Boom, 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 boom. A drying up of that, essentially, okay? And so, I mean, he's making a pretty big prediction here, potential 20% collapse. Like I said, that's not a small amount, needless to say. Satori Fund founder Dan Niles recently told Yahoo Finance that this week's hotter than anticipated inflation data, coupled with other central banks around the world already coming off their easy money policies, will likely corner the Fed into tapering its accommodative policies sooner than expected. This is interesting. I've always felt like interest rates could rise more quickly than a lot of folks have thought, right? We've heard a lot of talk about the Fed not raising rates till 2023. I always thought that's like a little unrealistic. I always thought the back half of this year or maybe 2022. And so this is part that I kind of agree with Dan Niles a little bit. I think it is very, very possible that the Fed could go from kind of this push of money out there to, potentially, raising interest rates and things like that. He says, if you've got food prices, energy prices, shelter prices moving up as rapidly as they are, the Fed's not going to have any choice, he says, predicting that the Fed could signal the beginning of a move to wind down its monthly $120 billion a month pace of asset purchases by this summer. Okay? They can say what they want, but this is his quote, okay? They can say what they want, but this reminds me to some degree of them saying back in 2007 that the subprime crisis was well contained. Obviously it wasn't, okay? Whoa! Hold your horses there, Mr. Niles, okay? Okay. You can't just start saying, like going back to something in 2007 and saying, this is that, because the Fed says a lot of things all the time, right? And, I think it's wrong to just put it back to, this is what they said in 2007, because the Fed can be right sometimes, the Fed can be wrong sometimes, okay? And to just say, this is the same type of situation back in 2007, that's like, whoa, slow down a little bit there, okay? Doesn't mean things can't get worse, but at the same time, think about it from this context, right? If the Fed, right, which the Fed is basically the U.S. government, okay? I understand the Fed is supposed to be its own separate entity, but let's be quite clear that the Fed is essentially the U.S. government, okay? Just don't tell anybody, okay? If we see any real weakness, like real weakness in asset prices starting to weaken majorly, right? I'm not talking about a little bit, but I'm talking significant 10, 20, 30%, right? If we were to start seeing, jobs dry up, things like that, I think the Fed would all of a sudden, what are they going to do? They're going to start sloshing money out there again, okay? That's what happens. That's what happens every single time. And that's like, this is essentially, if you talk about a kick in the can down the road type situation, this is what we're going to be in for all of eternity, essentially. If there's any major weakness in the economy, jobs, anything like that, asset prices, the Fed will start sloshing money out there, okay? That's the way it's kind of going to be moving forward. It doesn't mean you can't have corrections in the market or short-term things that happen in turbulence in the market. But at the end of the day, at the 2007 through 2009, that changed our economy, that changed our financial system forever. Literally forever. What happened during that time? The bailout of the banks, that was the stepping stone to change everything forever. Before that time, it was thought that, the government wouldn't back the private sector like that. The government would just kind of let things kind of play out. But that got so ugly that the Fed folks felt like the Fed had to step in, the U.S. government kind of had to step in and bail out all those private banks, or it was going to create a situation that was kind of like the Great Depression, right? Where we could have seen 20% plus unemployment for an extended period of time. And no one wanted to go through that situation. And so that was what changed our entire economic system forever. And so now anytime anything real bad happens, unemployment starts to rise, right? The market crashes. right then and there, immediately, the Fed's there to step in and just, here's the money. What do you guys need? 0% interest rates? What do you need? Just funding out there? Boom, okay? And once you've gone down that route, you don't go back. You don't go back. That is a change that is forever, okay? It's impossible to go back now. Because if you go back, then you create a Great Depression type scenario. You literally are stuck in a situation where you can never, ever not go back now, okay? So that is something important there that I think, folks just don't factor in. They're like, well, the Fed can pull back, blah, blah, blah. Okay? And then if things all of a sudden start to weaken, you know what the Fed's going to do? Whoo! Here's all the money in the world, okay? Something to take into account. I mean, if it wasn't for the Fed, I don't know where our economy would be today. We certainly wouldn't be in a position where there's jobs all over the place. I can't go anywhere without seeing hiring signs. It doesn't matter what it is, okay? I mean, I drive down the road and every dang building has a hiring sign. It doesn't matter if it's dang Taco Bell and Dairy Queen or if it's some, a furniture, manufacturer or a steel manufacturer. It literally doesn't matter. I get next to a semi truck. It's like a huge banner on the whole side of it, that they're hiring. I can't find anywhere that's not hiring right now. It's ridiculous, okay? And so if it wasn't for the Fed, I don't think we'd be in that situation right now. I think there's a high probability that jobs would have dried up nasty. I think there's a high probability it could have, we could have had a very extended recession here. But you know what happened? The Fed flooded money out there, stimulus money. Businesses got whatever they needed. And a lot of businesses are actually in a far better financial situation now than they were prior to the Rona. No one even takes that into account. If you're somebody like myself that looks at financial statements every single week of, a gauntlet of companies, like hundreds and hundreds of companies, what you're going to find time and time again is the high majority of companies have a far better balance sheet today than they had prior to Rona. Prior to Rona, I'm telling you, there were a lot of companies that honestly looked like they were on the verge of bankruptcy. Their balance sheets were bad. I'm talking almost no cash and super high debt. But all of a sudden, because of that huge sloshing of money, a ton of companies got to raise capital. And now I'm looking at all these companies that before Rona looked like they, potentially could have gone under. Now all of a sudden they're in great financial position. Okay? And so that's something really important to kind of keep in mind there. Okay? But as Niall points out, other economies around the world have already signaled their intent to shift away from accommodative monetary policies put in place during the pandemic, okay? By the way, hey, other YouTubers don't read perfect, okay? That what they do, I record live for you guys, okay? And we just read. The other YouTubers, they practice these lines 100 times, okay? So don't think I'm a dummy. I'm not a dummy, okay? I'm way too jacked up today, okay? The Bank of Canada already began its tapering, and the Bank of England became the second among the G7 nations to talk about it. A phenomenon, Niall says, that could push the Fed into acting quicker. Elsewhere, countries like Russia and Brazil have already seen a rise in interest rates. Interesting. He says, quote, this process has already started in other countries around the globe, and I think the U.S. is going to be lagging that and playing catch up, which is why it is so disruptive, he explained. None of this would honestly matter if valuations were low, but they're not. They're at record highs. So here we go. Valuations. He has a good point. He does have a good point, okay? Valuations are pushed up. More on large caps, okay? If you look at valuations, which we like to go through valuations a lot on the channel, right? And if you follow my content a lot, we go through valuations a lot, okay? And by the way, I appreciate all you guys for watching those videos that go through valuations and things like that. What we've seen, let's be very clear, is valuations on the big dogs, okay, the large caps have gotten pushed up. Absolutely. There's no debating that. What we have seen is mid caps are a little high, and what we've seen is small caps have actually come down quite considerably recently, okay? So I think we need to be very, very specific in where we're talking about valuations are pushed up, because it's really in the big dog stocks, okay? Now, here's where things get really, really intriguing, okay? The big dog stocks, right? If we're going to talk about Apple, if we're going to talk about Amazon, if we're going to talk about Facebook, if we're going to talk about Google, their earnings growth is the best it's been for a lot of those companies in 5, 10, 20 years. I mean, you look at some of these numbers Apple's posting, Google, Facebook, I mean, Microsoft, these are numbers, they're doing so much better than they've ever done. In any time in recent history. You look at their revenue growth, you look at their net income growth, their gross margin, everything for these companies is unreal. And so that's where you get in a situation where you say, okay, large caps looks expensive. However, these large caps are reporting explosive growth in almost any category you want to look at. Like the best growth we've seen from these companies in a long time. So if all of a sudden that growth dies down and all of a sudden Apple starts reporting so-so numbers and Amazon reports so-so numbers and Google reports so-so numbers and Microsoft and FB and NVIDIA and these other companies and AMD and all these, other companies, right? Then you get in a situation where it's like, okay, valuations have to come down. But when these companies are reporting ridiculous numbers and are absolutely smashing analyst estimates, well, how do you say these stocks should go down if they're just killing it quarter after quarter after quarter, okay? Maybe they deserve a little premium valuation on them because they're just absolutely decimating earnings, right? So that's a whole intriguing argument. And honestly, we don't know what's going to happen for sure with Apple's earnings and Facebook's earnings and Microsoft earnings and Amazon earnings. If I had to guess, as long as the economy stays pretty dang good, I think those companies are going to still continue to kill it quarter after quarter after quarter. And so these valuations go from, they look a little bit expensive to all of a sudden these companies keep reporting quarter after quarter some amazing numbers, and all of a sudden those valuations start to look cheap, right? Amazon stock at $3,000, if the earnings are just okay, maybe it does look expensive. But when Amazon's crushing their earnings estimates, which I think Amazon beat EPS by like 50% last quarter. I think if I recall, they beat EPS by like 50%, okay? That's like ridiculous, right? I think the company was supposed to do if I recall with Amazon, I think they were supposed to do $9 or something of EPS, and I think they did $15. I'm going to have to look back at the numbers, but it was something ridiculous. All I know is Amazon absolutely obliterated their earnings, right? And so if they just keep crushing earnings and doing way better than folks expect, all of a sudden Amazon at $3,000 starts looking cheap in 6 months from now, in 12 months from now, right? I mean, you could already make an argument, honestly, that Amazon looks already cheap, based upon where the growth is headed for that company over time. Never mind if they keep crushing these numbers quarter after quarter and reporting much better numbers than analysts expect. All of a sudden, Amazon at $3,000 looks like a joke, and it looks like the cheapest stock in the world, right? So that's something that is a big factor that I think sometimes folks don't really take into account, okay? As Niles charted on his blog, the market's 10-year break-even inflation expectations are at the highest level since 2013. Inflation concerns are as measured by the 10-year Treasury yield, have been held artificially low, he said, by an extension of the Fed's bond purchases. But talks of tapering that monthly $120 billion purchase program could change this summer. When Niall predicts the Fed will throw in the towel on its accommodative signaling, his thesis remains that a 10 to 20% correction would ensue. Hitting unprofitable growth names the hardest, as been the case so far in 2021. Okay, well, okay, all right. Where do we even go here? I think Niles might be a little late in this prediction, okay? I think if he made this prediction 3-6 months ago, I think it's looking ingenious, right? But as of right now, a lot of these unprofitable stocks, we look at these stocks all the time, right? I bring these out in videos and I show you guys this stock, and we'll go through like 10, 20 different stocks, right? All those retail names, a lot of those unprofitable companies that are growing massively and have a lot of excitement around them. What have we seen? A lot of those stocks are already down 50%, 60%, 70% from their highs, right? So a lot of those stocks are already decimated. It doesn't mean they can't get decimated more. But let's just take into account that they've already been smashed, hammered down, okay? Absolutely ugly, right? And so if you're thinking of things going either way, I think, especially when I see some of the short interest in some of those stocks that have already been hit 50, 60, 70%, I think if anything, there's more of a risk to the upside potentially this summer for those stocks than downside. Although you never know, things could, I don't know, maybe Palantir goes to $12, okay? Maybe I don't know, Corsair Gaming is not even an unprofitable company. That's a profit beast, okay? So that's not even a good example there. It's just a stock that's been hit, right? I'm just trying to think of other, popular stocks that are unprofitable that we go through all the time. I don't know, maybe those stocks go down another 20, 30% from here. But when the valuation's already pushed down so low and you've already had so much outflows of money, the outflows start to turn to inflows. And you start to say, okay, how can I make money in this market? Oh, this stock is 55% off its highs. This stock over here is 63% off its highs. This stock over here is 72% off its highs that it would hit a few months ago. Maybe it makes sense to dabble into some of these stocks, right? If you're a hedge fund. So that's something to kind of take into account there. I just think he might be a little late kind of with this prediction in general, okay? He says, this is important here, okay? He says, if after 13 years of the Fed giving you easy money, they now all of a sudden start to pull back, you're going to have to rethink where you're invested to get better risk versus reward trade. Hey, I love to talk about risk reward all the time, right? In lower valuation names that make lots of money, that's where you want to be. Okay, as a hedge fund manager, Niles revealed a mix of long and short positions and explained larger tech companies that have shown earnings strength, like Google and Facebook, might fare far better than unprofitable companies. Okay, so here's the thing. Okay, we got to talk here. Okay, so here's the thing. Well, if you're going to say, a lot of those big dog companies are going to fare far better, Google, Facebook, and, let's say Apple, Amazon, some of those big dogs, right? Microsoft, those are ones that control the market. Let's be quite clear. It's not, the smaller, more risky, unprofitable companies. Those aren't moving the market, right? Those aren't moving the S&P 500 because a lot of those companies aren't even in the S&P 500. Those aren't moving the NASDAQ. That's not the way this works, right? They're not in the Dow 30. The names that are moving the market are Google or Amazon or Facebook, Apple, Microsoft. Those are the stocks that are moving the market, right? Tesla, Nvidia, big companies, Intel. Those are the companies that are moving the market up and down on a daily basis, okay? And so if those companies are going to fare far better, how do you get the market to fall 20%? That just doesn't make sense, right? And so that's where I kind of push back and I'm like, it just doesn't make sense, man. It doesn't make sense at all. Those are the ones that, because then if you're saying those are the ones that are going to fare, are going to do much better, and let's say hypothetically all those stocks fall 20% and drops the market 20%, that's basically saying that a lot of those other stocks are going to fall another 40, 50, 60%. I don't think that's realistic for a lot of those stocks because a lot of these funds that have been outflowing money for the last several months in the market, they've got to get back in. And I'm telling you, I'm already starting to see it in some of these stocks, right? We're already seeing some of these stocks bounce back, right? Tattoo Chef's a perfect example. TTCF, look at all this on this Wall Street money's flooding in, right? You don't get that stock to make that move up today without, there was some big money coming in that, right? For that to go up 10% on a down day, right? Look at Palantir recently. Palantir's a market cap of what, 35, 40 billion dollars. All of a sudden, money's starting to flood back into that one, right? There's got to be some hedge fund money and things like that starting to come back into these stocks. It doesn't mean they can't go back down to their lows or something like that. I just think it's a little misguided to think like, the market could fall 20% when you see these companies' earnings are just amazing. Now, like I said, if these companies' earnings were to weaken substantially, that changes the market. And now you have an issue. If valuations are high and all of a sudden Apple is missing earnings and Amazon's missing earnings and Google's missing earnings and Facebook's missing earnings and Microsoft's missing earnings and Tesla's missing earnings and Nvidia's missing earnings and AMD, then we got a whole different scenario. That's a whole different scenario. Then I can 100% see the market falling 20%. That makes perfect sense, okay? But outside of that scenario, it's very, very hard to see the market go down in a massive, massive way, okay? And so that's kind of where I stand on this. I always like to, I don't like to make judgments on where the market can go, or up or down. I mean, there's just been, if you go back to March 2020, I don't know one soul who really thought, the market would be where it's at today. I don't know one person. Honestly, I don't. That could have told me the market would be at pretty much, around record highs, and that, there would be mass hiring out there and companies couldn't even fill jobs, okay? No one could have told me that back in March of 2020. It would have been ridiculous to say that, okay? And that's a scenario we got. So, I think it's fun to talk about these things. I think it's interesting to, kind of on an academic level, kind of talk about these things and weigh all the different things. But at the end of the day, I like to focus on buying companies I love that are undervalued. And regardless what happens to the market, those stocks will perform amazing, in my personal opinion, over the next 4, 5, 6, 7 years. And that's where I like to focus. So anyways, hope you guys enjoyed this. As always, all I ask in return is that you smash that thumbs up button. That helps out huge in the YouTube algorithm. I appreciate you guys being here. Much love as always. Make sure to subscribe to the channel. And peace.